Tesla stock at the time of recording this video is down almost 5% on the day today, and we have good news. No, this 5% drop is not bad news. Tesla is being essentially attacked for many different reasons, and well, the 50% fall in Tesla has nothing to do with company fundamentals more than it has to do with recession risks and overall uncertainty. In which here on the day today, we actually have some good news to go over for Tesla. But as I explained in the last video, unfortunately, these bounces are not going to hold because there's so much uncertainty. They're going to be sold until either Trump caves on the trade war, or until we have more clarity that the economy is going to be okay, or the Fed turns bullish. Until something like that happens, we're going to continue to fall. People are not going to buy the dips. They're going to sell the rips. And unfortunately, as a consequence of that, Tesla will likely continue lower. But if you are scared of a stock falling, you should not be invested in markets. If you look at the opportunity being presented to you, you will get rich. There's no other way to put it. When a company sells off 50%, when the fundamentals are improving, that is not something to be scared of. That is an opportunity. We will discuss that in this video as well, but more on this in the next video coming out at 8 p.m. Eastern Standard Time tonight. Trust me, you do not want to miss it. Gigafactory Berlin News on X reported that Giga Berlin plant managers are ruling out job cuts and short time working. There are, quote, no plans for production stoppages, job cuts, or short time working, said Andre Thie, Senior Director of Manufacturing at Giga Berlin. The opposite is the case. Production is, quote, not being reduced, but is currently being ramped up again. Wow, that is so much different than other car companies right now. And for people to even make the comparison that Tesla's a car company probably means they don't understand Tesla to begin with. But comparing apples to apples, Tesla seems to be doing better than 99% of other car companies. Also in the news today, 43,411 Teslas were registered in the United States in January, making Tesla the #1 best-selling EV brand in the country once again. Registrations were down about 11% compared to January of 2024. So only down 11%. That's a much better number than Europe, China, and other places. Some of these scary headlines we've gotten recently. But the fact of the matter is, production essentially stopped of the old Model Y. And we can see this via the weekly data we get out of China, that the last 4 or 5 weeks, really 6-7 weeks ago, there was no deliveries of the Model Y, like none at all. And that happened on a global scale. All of a sudden, the best-selling vehicle in the world stopped selling. Why? Because there were none left. They were not producing anymore. They were switching over to the new Model Y, and customers that were going to buy a Model Y, the older one, were advised to just wait for the new one. So people put in a lot of pre-orders, and you're going to see these delivery numbers absolutely explode from here. So all of the nervousness that caused, I believe, the first 20-25% sell-off in Tesla, a lot of that's going to go away here soon. And that's going to be a sigh of relief for scared investors. Now, it should also not be a surprise that Tesla is down today, considering Jim Cramer last night says that Tesla could hit $500 in 2025.
Yesterday, the stock started rebounding, and today it tacked on another 7.6%. So you got to ask, could this be the real deal? Now, listen, it's hard to predict the fundamentals here, in large part because Tesla trades on the potential of its self-driving technology, something I very much believe in, but that could be years down the road. It's also hard to put a value on your CEO being the right-hand man of the president. No one's ever done that. It's definitely worth something, but how the heck do you put a number on that? What's the PE multiple on that? So rather than trying to game this one out, you know what? I'd rather go off the charts. And I never do this at the end of the show, but this is really important because we're going off the charts with Larry Williams. He's the legendary technician and market historian who's been the best in the business since before I learned how to drive. He's written over a dozen books, created a ton of proprietary technical indicators, and most important, he's got a stunning track record, especially over the past 5 years. And I revere him, always have. Larry's the one who called the COVID bottom, for instance, in April 2020, back when just about everyone was terrified that we'd be stuck in a prolonged government-mandated recession. And you know what he's doing tonight? He's calling the bottom in Tesla. First, I want you to take a look at the weekly chart of Tesla paired with Larry's proprietary valuation model. According to this model, Tesla's finally reached undervalued territory. And when the stocks come down to these levels in the past, it typically attracts real buyers. It leads to a big bounce. Speaking of buyers, check out this chart of Tesla's paired with Larry's measure of professional accumulation. Even as the stocks come down, this picture shows very aggressive buying. Not selling, but buying. That's typically an harbinger of higher prices. Professional money managers have begun adding to positions while individual investors have been throwing in the towel. That's what you've seen. And it usually means that you should be buying alongside of these investors. I agree. But is this the right moment to pounce on Tesla, or could it have another leg down in the brutal stock market? Okay, I want you to take a look at this daily chart with Tesla true seasonal pattern in blue, okay? Larry loves to look at how stocks tend to trade over the course of the year. He goes over the history, then finds the seasonal pattern that plays out time after time. The true seasonal pattern in blue shows that Tesla typically begins rallying at this time of the year. Sure enough, the stock's already going up. So I've got to tell you, I'm with that. Now, Larry also likes to hunt for cycles that seem to be repeating themselves beyond the annual seasonal cycle. Now, he'll identify a bunch of these, then combine them together into a wave that predicts where the stock is likely headed. So here's what Tesla looks like with this cycle forecast attached to it. The forecast is blue on the way up, gray on the way down. Right now suggests that Tesla should be ready to rally, maybe furiously, with a pullback creating another buying opportunity around mid-June. Larry notes that we've seen this wave in Tesla stock numerous times before historically. Stocks rallied 80% of the time during this time period. I think that's pretty good odds. So if you believe Larry Williams, and he's earned a lot of credibility over the years, then this is a gentleman start your electric engines moment for Tesla. Assuming he's right, the stock's rebound of the past couple days is just the beginning of a huge move. And I got to tell you, all aboard! I'm with Larry.
Oh yeah, I think that's hard to argue against. We all think Tesla should be higher than where it is today. And the issue is not with Tesla. It is with the broader markets and the growth scare. The problem is this is more than just a growth scare. People are actually seriously pricing in a recession. You could see this with the collapse of the momentum stocks. And overall, XLP, consumer staple ETF, that has done well in recent weeks. You could see this in the rise of 10-year treasury yields and the plummeting of oil. So I think it's really as simple as this. If we avoid a recession, if inflation comes down, as true inflation is suggesting, true inflation says that you're going to see an absolute plummeting of inflation over the next couple of months. That, I think, will happen. But is that at the consequence of a weakening economy? Probably. In that environment, that's not a good one for stocks. Because the fact of the matter is, we are not priced for a recession. We're not. No way in hell are we priced for a recession after a 10% decline. And that's why people are not going out and aggressively buying this 10% correction. We're all kind of waiting to see, are we going into a recession or not? Because the sad truth is, if we avoid a recession, but we're now in a slow growth environment for the foreseeable future, getting back to new all-time highs, 10% rally from here is probably the extent of justifiable. But if we go into a recession, you could justify another 30+% decline from here on our markets. That's where I really don't like the risk-reward setup. But Tesla's already fallen 50% from all-time highs. If we avoid a recession, Tesla could easily be a double or triple from here by the end of this year. In the event we do go into a recession, could Tesla fall another $100? Yeah, that's definitely possible. That could put the stock at about $140 per share. But do you see the situation? I like the risk reward. The risk to the downside is smaller than the potential reward to the upside if we don't have a recession. That's what is attractive about buying Tesla here. But you need to understand, if the economy weakens and we go into a recession or even close to one, Tesla is probably going to fall further. And that's the issue right now with markets. The issue is not with Tesla. The issue is with the markets. Now, also in the news today, Tesla has partnered with Baidu to integrate Baidu's mapping tech into FSD v13. Now, Baidu is like the Google of China. So China is, essentially, or Baidu is essentially partnering with Tesla to better the system in China. That is great news. And it really shows a further commitment and validation that FSD technology will be in the Chinese market. China has a bunch of funky rules where if you're a US company, you have to partner with Chinese companies for new tech to be brought into the country, which makes sense from a, protecting your country's industry kind of perspective. And that's kind of what you have to do if you're Tesla or any company trying to do business in China. So that's actually a really good sign. Now, part of what caused markets to sell off today was not the better than expected PPI, although that could be a little worrisome if you look at that from a different perspective. Trump says that if the EU does not remove tariffs on whiskey, the US will put a 200% tariff on all wines and champagnes coming out of the continent. And as I said, PPI, the headline month over month, came in at 0.0%. Expectation was 0.3%. So that was a big miss to the downside. US PPI for core came in at negative 0.1% month over month versus the expectation of 0.3%. PPI headline year over year came in at 3.2% versus 3.3% was the expectation. And PPI core year over year came in at 3.4% versus 3.6%. Now, the month over month plummeting of core and headline can be a sign that the economy is weakening. More often than not, when inflation is falling or even going negative in the case of core PPI, you see the economy also weakening at the same time. We've seen this in China. China has struggled with deflation in the last year or so, and the Chinese economy has not exactly been doing that great. Now, one of the biggest permables, Ed Yardeni, just chopped his end-of-year S&P target from 7,000 down to 6,400 with a worst-case scenario of 5,800. He is really cutting the valuation multiple, now expecting a range of 18 to 20 instead of 18 to 22. And according to a new CBS survey, 60% of Americans currently say the US economy is bad. And Dollar General is sending a major warning about the economy today, and this could also be affecting markets. Dollar General's CEO says, quote, trade down to cheaper brands appears to have accelerated in the past few weeks among both lower and higher income customers. Yikes, that is alarming. They say, quote, our customers continue to report that their financial situation has worsened over the last year as they have been negatively impacted by ongoing inflation. He goes on to say, quote, as we enter 2025, we are not anticipating improvement in the macro environment, particularly for our core customer, which does tend to be the lower income earners. They say, what has really become apparent leaving the fourth quarter and moving into the first quarter is the trade down is back in both mid and higher priced categories. Wow. He says, so far, there's nothing that suggests the trend is slowing. If anything, we may have seen it accelerate a bit in the past few weeks. That's really bad. 70% of the consumer, or 70% of the economy, is consumer spending money. Like, if people are spending less money, that is directly tied to GDP and directly tied to recession odds. So Dollar General, being a wide-spanning company that has presence in almost all 50 states, that's not a great sign. This follows other warnings you've already heard from Home Depot, Lowe's, Walmart, and virtually every other retailer that has reported earnings. Now, also negatively affecting markets today, Treasury Secretary Besson said the White House is focused on the, quote, real economy and not concerned about a little market volatility. He says, we're focused on the real economy. Can we create an environment where there are long-term gains in the market and long-term gains for the American people? Quote, I'm not concerned about a little bit of volatility over 3 weeks. Quote, the reason stocks are a safe and great investment is because you're looking over the long term. If you start looking at micro horizons, stocks become very risky. So we are focused over the medium and long term. I can tell you that if we put proper policies in place, it's going to lay the groundwork for both real income gains and job gains and continued asset gains. He also said, quote, maybe the inflation is getting under control and the market is going to have some confidence in that. Well, so far that doesn't seem to be working. The Dow is down 1.36%, S&P is down 1.5%, the NASDAQ is down 2.12%, and Russell 2000 is down 1.33%. The VIX is also up about 5.5% today, but a pretty small move relatively speaking. We were at about 28 just, 3 days ago? So the VIX has actually fallen a bit, and this does not look like the process of forming a bottom. You need capitulation to form bottoms. You need everyone to rush into puts in order to really flush out positioning. That has not happened yet. This is not suggestive of even a short-term bottom, although I think we need a short-term bottom. And one of the more messed up things about this market is there's so much intraday volatility. Some days, like in the past 3 days, for an example, we hit a bottom around 552 before today's low. We're hitting a new low of this cycle. But you hit that low and you bounced over 2% by the next day. But both days, I mean, you were only up 0.5% yesterday. So technically, you bounced over 2% from the lows, but you only had a 0.5% green close. So there's a lot of that intraday volatility where you are getting bounces, but it's not holding. And yesterday's bounce was really lackluster considering we're in a 10% correction. You would want to see like a strong bounce. That did not happen. Also in the news yesterday was the Bank of Canada's Governor McLean that says, I am not ruling out an unscheduled rate move if something severe happens suddenly. I pointed this out in the last video that this is really alarming for the American economy as well, because if you look at the unemployment rate of Canada and the US, we tend to follow each other. Like these tend to look almost identical, okay? And we go into recessions at the same time. So for everyone to be nervous about Canada going into a recession, or for, Bank of Canada governors to be talking about emergency rate cuts, that's actually a big red flag for the US economy as well. Couple that with all of the recent data that we have had, and I'm not surprised stocks are still selling off. Now, we do have one earnings in particular today and after hours that will be important. That is Ulta Beauty. Now, you've seen weakness in cosmetic companies recently, but Ulta Beauty is like the retailer side of that. So if Ulta has bad things to say about the consumer, just add one more kind of validation to the recession concerns to the list. You also have earnings from DocuSign and Semtech today and after hours as well. Now, as Ryan Dietrich points out on X, bears are above 50% yet again. In the new AI investor sentiment survey that came out today, this is the first time this has happened since the October lows in 2022. And before that, you have to go back to March of 2009. So, I mean, this is normally what you see as markets are down 30-ish% from all-time highs. This is very abnormal to be happening as markets are still only down 10% from all-time highs. This to me is not exciting. This to me is actually a big red flag. Now, couple that with the flows data from ETFs, you can see QQQ flows for the last 30 days are actually negative around $418 million. Even during 2022, you only had one negative month, and that was April of 2022, and you were negative $9.5 million. People are rushing out of these stocks in a way that you have not seen in a very, very long time. Now, again, the AI Investor Sentiment Survey currently shows bullish investors at 19.1%, neutral investors at 21.7%, and bearish investors at 29.2%. Also, again, creating some of this uncertainty today, Chuck Schumer says that Democrats will be blocking the CR bill from passing, which will likely result in a government shutdown on March 15th. That is 2 days from now. 60-day plus auto loan delinquencies in the subprime cohort, that is less credit-worthy borrowers, hit 6.56% in December of 2024, the highest ever recorded. That's up from 6.01% in November of 2024 and 6.27% in 2023. Barclays now sees 2 Fed cuts in 2025 after cutting US GDP estimates. Barclays analysts cut US GDP growth for 2025 to 0.7%, down 0.8%. So they cut their growth estimates by 60%. That's a huge downgrade. They raised their inflation expectations to 3.2%, up 40 basis points or 0.4%, citing higher tariffs and trade uncertainty under Trump. They now expect 2 Fed cuts in 2025, 25 basis points each in June and September, due to a weaker labor market, up from 1 and 3 more in 2026. March, June, and September. Tariffs are now assumed at 15%, up from 10%, with unemployment rising to 4.2%, up 0.4 percentage points. That's not very comforting if you are getting nervous about a recession. I mean, GDP growth only at 0.7% is getting a little too close to that threshold for comfort. And also, to the point that I made earlier, core PPI was negative today. This is only the second negative print since 2020. So normally, like you could see 2021, right? Yes, you had a lot of inflation. 2022, even 2023. Yes, you had a lot of inflation. Core PPI was high, but that is also correlated to good economic growth. And even what we've seen recently has been okay, right? Growth has been okay. Inflation has been higher. Well, now you're going negative again. Is this a sign of a weakening in the economy? I think you can make that argument pretty easily. IWM is on track for its 7th consecutive red week, which would be its longest losing streak in history. This has never happened before. And that's why I think right now, again, is really not the moment to be buying the dip. There's way too many red flags out there, way too much uncertainty that the economy could be heading towards recession. I mean, you want to listen to the money. And when the money is dumping momentum, they're dumping IWM. You've seen the first month of outflows for the QQQ since COVID. Like, you want to be a little nervous. Or cautious, I should say. And as, again, I mentioned earlier, the NASDAQ 100 has now seen an intraday drop of at least 1% for 16 consecutive days. So you're really getting these big drops, these big rallies. So you are getting some bounces, but they're immediately being sold. It's just a way to really liquidate positioning without being as destructive on the broader markets. And the S&P 500 hits its most oversold level since September of 2022. Trump said this about the government shutdown negotiations: "If they need me, I'm available." Mnuchin, the Treasury Secretary for Trump the first time around, says a 5 to 10% correction in stocks makes sense, and it's natural. He says, I don't forecast the US at all going into a recession. Trump says we've been dealing with Denmark and Greenland, and he says that he thinks the annexation of Greenland will happen. And in case you didn't know, Trump says that he inherited egg price problem. Trump said today the EU and China are treating us very badly, going on to say that the government shutdown might lead to very, very high taxes. And he says a government shutdown could delay the tax bill. Trump says that he will not bend on Canada metals or April 2nd tariffs. Trump says there will be a little disruption and won't be long. Again, let me just make this clear. The Trump administration is trying to push us into a recession. I think there's an interesting dynamic going on here, though, because I think the average American, middle income, low income, average income American, believes we've been in a recession for a long time. I think that's why they voted for Trump. So, I think they're already in a bad situation with a lot of people that fail to make ends meet. What Trump is really trying to do is kill inflation, lower interest rates. The only way historically to really do that is with a weakening economy. And I think that's the playbook here. And I don't want to step into a freight train, okay? I'm going to stay out the way of the freight train, let it pass, and then, go over the tracks afterwards. Trump says we don't need Canada's cars, energy, or lumber. Now, there was also positive news about a potential 30-day ceasefire with the Ukraine-Russia war. That did momentarily boost markets, but it was sold off pretty fast. You can also see that the fear is coming back today in markets. TLT is getting a bid today in the likes in which we have not seen, at least in the past couple of days, as markets have sold off really since March 4th. TLT has not really moved higher. Periods, certain instances you have. But today is the strongest day since at least March 10th. But we'll see where things hash out by the end of the day. This is good if you own TLT. Maybe a bad sign for equity markets, though. Now, the good news is, for anyone that wants a bounce, you're almost at your 300-day moving average. The last time this happened, you almost hit it back here in October of 2023, but the last time this happened was really like 2022, right? You fell below this and you found a lot of resistance at this 300-day moving average. So you're getting back to a level you really haven't been at in years. And I would expect you to get a bounce at this level. And you're probably going to ping pong between the 200-day and the 300-day moving average for a little while. But I do think ultimately you're going to head down to this 500 level on the SPY, which is your 500-day moving average. That would put your peak to trough decline of about 19% at the bare minimum. You could fall more than that if we do go into recession, but I think you have another big leg down to go. Just not certain when that is going to happen. Do we bounce aggressively before then and then sell off? Probably. Now, you should have bounced harder already, and you have gotten these, 2-ish% bounces, but a lot of it's happening intraday. So you don't really feel it. It doesn't really feel like a bounce. And this is actually the fastest sell-off you've seen in like many, many years. This is a faster sell-off than 2022. So it really just depends what comes next as far as the economy, economic data, and the news flows that we get. Because if, again, it continues to look like we're heading towards recession, markets are going to get worse from here. I mean, this is people are fighting what is happening right now. And I think whether it's the administration or where the money is moving, it's all pretty clear to me that things are getting worse. Things are weakening. Things are not great right now. And I personally don't want to fight that with a downside that is so much larger than upside. Now, once we get down to 500 on the SPY, then you look more appropriately priced for recession risks, right? Because then if you want to go down to your 2022 lows, if that's where you say pricing in a recession, really could happen, that would still be 32% downside from 500 on the SPY. Like, that would still be massive downside, but the upside in that scenario, just to get back to new all-time highs, would be 20%. That's where I think the risk-reward, or 22%. That's where I think the risk-reward becomes a little bit more even. And that's why I think at least 18, 19% top to bottom decline before this is over with. But if we go into recession, it's going to be more than that. So let me know what you guys think about this down below in the comment section. I would love your thoughts here. I know it sucks being patient. I know it sucks that markets are not V-shape recovering. But the faster you get used to that, the faster you accept that, the better off you're going to be. And the more money you're going to make. And ultimately, you could get rich if you play this the right way. With that said, ladies and gentlemen, thank you for watching. Enjoy the rest of your day, and I will see you in the next one.